The Loanable Funds market is a theoretical market that brings together those who want to borrow and or save. There are several parties that participate in the Loanable Funds market. They are households or consumers, the government, foreigners, whether it's consumers or business, and domestic businesses. There are several financial institutions that provide loanable funds to the previously mentioned groups. They are banks, mutual funds, credit unions, pension funds, and insurance companies. The market for loanable funds is represented in a supply-demand model. Remember that this is a hypothetical market because there are a variety of loans, such as a car loan, business loan, or a mortgage, and interest rates that are attached to each of those loans. Economists assume that there is only one financial market and one overall interest rate that both represents the returns on savings and the cost of borrowing. The y-axis represents the real interest rate. Economists assume in this loanable funds model that prices are not changing, therefore the real interest rate is used. Remember, the real interest rate is adjusted for inflation and is equal to the nominal interest rate less the expected rate of inflation. The x-axis represents the quantity or amount of loanable funds that is available for saving and or borrowing. The supply curve represents saving, and it is upward sloping because with a higher interest rate, there will be more quantity supplied of loanable funds because of the high return on. The demand curve represents investment, and it is downward sloping because with a lower interest rate, there will be more quantity demanded of loanable funds due to the low cost of borrowing. So remember that the supply curve represents savings, and there are several events that can shift the supply curve left or right. The first event is the behavior of savers. If the income of savers increase, then it is assumed that the excess income would go into savings, hence increasing savings. The supply curve would shift to the right, decreasing the real interest rate and increasing the quantity of loanable funds. If the income of savers decrease, then there is no extra income. Therefore, savings would decrease, which would increase the real interest rate and decrease the quantity of loanable funds. The second event are foreigner consumer producer inflows. If the United States currency is weak in relation to another country, that means our goods are cheaper to purchase. So the supply curve or savings would shift to the right. If the United States currency is strong in relation to another country, that means our goods are more expensive to purchase. So savings would shift to the left. The third event is open market operations. Open market operations are when the Federal Reserve sells or purchases bonds. When the Fed buys bonds, this increases the money supply. This also increases savings, shifting the curve to the right. When the Fed sells bonds, this decreases the money supply, which also decreases savings, shifting the curve to the left. The fourth event are incentives to save. Incentives play a powerful role in behaviors. When U.S. citizens file income taxes, they sometimes include the interest amount that was gained from their savings account, and it is taxed. If the government wants to encourage the citizens to save, they could reduce the taxes. Reducing taxes on the interest of savings shifts the supply curve to the right. If the government needs revenue, however, they could increase the amount of taxes on the interest of savings, which would shift the supply curve to the left. Now let us look at the demand curve. And in the Loanable Funds model, it represents investment. Remember, in economics, investment is defined as the purchase of new physical capital, such as buildings or equipment. The first event that would shift the demand curve would be technology. If new technology is introduced that would make production more efficient, or the cost of technology has reduced, then the demand for loanable funds would shift to the right, which would increase the interest rate and increase the quantity of loanable funds. If technology becomes obsolete or more expensive to maintain, then demand for loanable funds will decrease, which also decrease the interest rate and the quantity of loanable funds. The second event that would shift the demand curve would be the investor expectations for the future. If investors have a positive view on the nature of the economy, then the demand for loanable funds would increase or shift to the right, because they believe that they will receive a great return on their investment. However, if investors have a negative view on the nature of the economy, then the demand for loanable funds would shift to the left. The third event that would shift the demand curve would be the government policy on investment. If the government decides to give investors a tax break or a reduction in taxes, then the demand for loanable funds would shift to the right. If the government decides to increase the taxes on investment as a result of an amazing return on that investment, then the demand for loanable funds would shift to the left. It is very important to note that this model is complicated by the fact that consumers and producers can act as both suppliers and demanders of loanable funds. Therefore, make sure that when you are reading the scenarios for the exam, you pay close attention to what is being asked.